Oh shit, my brothers. You need to wake up and look at your screens right now because a silent macroeconomic monster is tearing through the foundations of the global financial system. I am sitting out here right now surrounded by the beautiful sun-drenched views of the south of France, but I am honestly completely pissed off. I am deeply frustrated because the massive institutional players on Wall Street are looking at data that is actively predicting a catastrophic systemic shift. While everyday retail investors are being left completely in the dark, the United States bond market is flashing a structural alert so severe that top-tier banking executives are whispering about a total systemic reset. Yet the mainstream financial media is keeping the public completely blind. We are witnessing a structural fracture in the global debt markets that has historically preceded every single major wealth destruction event in modern financial history. The terrifying reality is that 99% of working-class people have absolutely no idea that the foundation of our entire economy just cracked wide open. The massive hedge funds and billionaire institutional desks are quietly repositioning their trillions of dollars of capital while sending out panic, inducing internal memos that you will never see on the nightly news. But we are completely breaking that information monopoly right here because every single historic economic collapse is ultimately just a violent, rapid transfer of wealth from the uneducated to the prepared. This coming storm is the ultimate arena where an individual with a strict, rule-based framework can realistically turn a $10,000 position into $100,000 of generational wealth in less than a year. The only real question you need to ask yourself as the system begins to buckle is whether you will be strategically prepared to strike or if you will freeze and panic, like everybody else when the herd starts running for the exits. My name is Felix Breen, and I have spent the last decade of my life obsessively studying the mechanics of historic market crashes, not to indulge in doom and gloom, but to systematically profit from the inevitable chaos. I firmly believe that you deserve absolute, unadulterated access to this institutional research just as much as some wealthy executive managing a multi-billion-dollar portfolio behind closed doors. If you agree with me that everyday people deserve to know exactly what is happening to the purchasing power of their money, I want you to type the word deserve in the comments right down below. I did not just bring you the raw, alarming data from this institutional bond report. I also built a comprehensive step-by-step explainer guide that breaks down the math into plain English. Those high-paid Wall Street analysts love to write in incredibly dense, intentionally confusing jargon to keep regular people feeling powerless. So I completely translated their formulas into actionable strategies. You can download that complete defensive blueprint entirely for free right now over at felixbreen.org/doom. With absolutely no credit card required or hidden catches, the secure link is sitting right there in the description and pinned in the top comment. So secure your copy, but let us dive directly into the cold hard data that is keeping central bankers awake at night. The very first massive economic alarm bell screaming from the charts is a phenomenon that top macro strategists are calling the historic Maginot Line of the global debt market. Now, if you remember your history classes, the original Maginot Line was a massive, theoretically flawless defensive wall constructed before World War II that ultimately failed under strategic pressure. In our modern debt-fueled financial system, that defensive wall was the 30-year United States Treasury yield, and it just aggressively slammed right through the critical 5% threshold. Let us break this concept down into dead simple terms, because bond markets sound incredibly boring, dry, and confusing to the average investor who just wants to grow their portfolio when you lend your hard-earned capital to the United States government. For a duration of 30 years, they hand you a legal contract promising to pay a fixed, consistent interest rate called a yield. For decades, that critical borrowing rate has safely remained well below the 5% mark, acting as a structural dam that held back global economic chaos and kept capital flowing into risk assets. But when that yield violently breaks above 5%, it signals that the largest credit investors on the planet are actively demanding a massive risk premium from the federal government. They are forcing the state to pay significantly higher interest because they perceive massive structural danger, meaning the smartest institutional money in the room is getting deeply terrified. Bank of America deeply analyzed every massive economic bubble across human history, including the 1989 Japanese collapse, the 2000 dot-com tech wipeout, and the 2008 global banking crisis. The underlying macroeconomic pattern they uncovered is completely identical every single time, because when long-term sovereign borrowing costs go to the moon, the speculative boom loop instantly dies. The financial dam that sustained the post-pandemic bull market is officially cracked, and according to the internal warnings floating through institutional channels, there is no real silver lining on the immediate horizon. That is just the first warning sign, and it is honestly the most complex macro concept we will cover today. So take a deep breath and let the gravity of that layout sink in. The rest of the data points are much easier to visualize. but I intentionally wanted to shake you awake with the heavy debt mechanics first, so you understand that the global game has structurally shifted. Alarm bell. Number 2 is what quantitative analysts call the historic 4% core inflation rule, which is backed by a full century of verified macroeconomic data. When the core inflation metric sustainably climbs and holds above the 4% threshold, a very specific mathematical domino effect triggers across global equity markets historically. Over the past 100 years, stocks suffer an average drop of 4% over the immediate 3 months following this trigger, and then slide down an additional 7% over the following 7 months. Right now, consumer prices are aggressively rising at nearly 4%, but the true systemic nightmare is buried deep inside the producer price index numbers. Wholesale manufacturing and raw production costs are currently skyrocketing at a massive 6% clip, which is an undeniable leading indicator of incoming retail pain when those massive manufacturing costs inevitably trickle down to the retail shelves. Consumer purchasing power gets completely wiped out across the nation. You will have significantly less disposable income to buy basic goods, retail spending velocity will freeze, and corporate profit margins will take a massive hit to fight this persistent structural inflation. The Federal Reserve is trapped into keeping interest rates elevated, making corporate debt refinancing and consumer borrowing incredibly expensive. Those sustained high borrowing costs absolutely crush stock valuations, while energy costs, electricity bills, transportation logistics, and rent prices pump higher across the board. Top institutional desks are explicitly projecting that we are heading straight into a sustained 5% inflation environment, which means history is rhyming with terrifying precision. Now, I promised you a massive, highly profitable silver lining that the big banks refuse to put in their warning memos, and I am going to give you that exact roadmap if you stay with me. But first, we absolutely have to look at their third visual alarm bell, which market veterans colorfully refer to as the alligator jaws of Wall Street. I want you to visually picture a massive alligator opening its mouth wide, where the top jaw represents the stock market melting up to artificial record highs fueled by speculative momentum. The bottom jaw represents the underlying bond market collapsing downward as yields spike. And right now, that physical gap is the widest it has ever been in modern financial history. The fundamental, unyielding laws of capital markets dictate that these alligator jaws must always eventually snap shut. And history shows there are only two paths forward. Scenario A is that the stock market violently crashes downward to meet the underlying reality of the bond market, which is incredibly painful for unhedged retail accounts. Scenario B is that bonds miraculously rally upward to meet stocks, which would require structural inflation to completely vanish into thin air overnight, given the current geopolitical chaos and massive supply chain shifts. Scenario B is mathematically improbable, meaning Scenario A is the highly probable outcome waiting to strike. When those alligator jaws inevitably snap shut, the market correction happens with extreme speed, completely wiping out anyone who is over-leveraged and underprepared. So just let that geometric reality sink into your mind for a quick second. Drop a comment below right now and tell me honestly if you believe our current asset prices are living inside a massive central bank inflated bubble. By simply understanding these three institutional warnings, you now officially possess a deeper grasp of macroeconomics than 99% of the retail traders playing the markets. Today, I know this data feels completely overwhelming, heavy, and dark, but this is precisely where the narrative shifts and gets incredibly exciting for disciplined investors like us. I have spent the last several months meticulously analyzing individual stock charts and sector performance during and after these massive, terrifying market liquidations. The historical data reveals a beautiful, undeniable truth that the giant financial media corporations will never openly advertise to the general public. Market crashes create self-made millionaires. Let us look at the actual historical data points from the 2020 pandemic crash when the entire world was locking down and unemployment claims were spiking to historic highs. If you had the strategic courage to allocate $10,000 into a brutally beaten down industrial company like Freeport-McMoRan, you would have walked away with $98,000 just 24 months later. That is nearly a massive 10 times return on your initial capital in 2 years, while the rest of the uneducated crowd was panicking and selling at the absolute bottom. If you bought Royal Caribbean Cruise Lines at the absolute depth of the economic freeze, your capital would have multiplied by a massive 9 times. Zoom Video gave prepared investors a massive 7 times return, and Block did the exact same thing by multiplying investor capital by 700%. The average winning asset coming out of that massive systemic crisis multiplied by 5 times in less than 24 months. If you study the brutal 2008 global financial crisis, you see the exact same wealth-building patterns play out across different sectors all over again. Royal Caribbean went on a massive 9 times run from its absolute lows, while Bank of America stock printed a 6 times return for those who bought when there was blood on the street. Freeport made the list again by printing a massive 7 times return, and Caterpillar multiplied investor capital by 500% as the global economy recovered. The smart money does does not freeze or cry when macro panic hits the tape. They systematically buy high-quality cash flowing assets at steep historical discounts, but you absolutely cannot just throw random darts at a board or buy random penny stocks. You need a strict math-based rulebook and a tested wealth building framework. A massive 30% market correction is mathematically inevitable at some point in the macro cycle, and most people will lose their minds and liquidate their accounts at the worst possible time. But the elite investors who know exactly how to read the data will be quietly positioning their capital for 5 times and 10 times returns. That is exactly why I am hosting a completely free comprehensive live training event this weekend called the 10 Times Crash Returns Blueprint Workshop. I am going to completely break down the exact mathematical framework for identifying these massive crash winners before they start their historic upward runs. We will analyze which specific economic sectors produce the largest gains, the exact technical indicators for timing your entries and exits, and how to avoid deadly value traps. The masterclass is completely free. It will run for about 2 hours, and you can secure your entry ticket right now over at 10xreturns.org. The secure link is sitting right down below in the description, and since it takes an immense amount of personal energy to host these sessions, I will likely never run this specific workshop again. So grab a fresh notebook, grab a pen, tell your close friends, and make sure you show up completely on time because there will be absolutely no replays available. This is easily the biggest wealth building opportunity we will see in the next decade, so do not sleep on this event. But let us look deeper into what Bank of America is highlighting regarding the psychological mechanics of the current market bubble. When the stock market artificially pumps higher, every day people look at their mobile brokerage apps, see their portfolios up, and instantly experience a psychological wealth effect. They start spending money aggressively in the real economy because of this paper wealth, which causes corporate revenues to temporarily look incredibly strong. That corporate strength drives stock prices even higher, creating a massive, self-reinforcing happy loop that feels like it will last forever. United States household equity wealth has skyrocketed by a staggering $4 trillion just this year alone, following a $10 trillion gain last year. That sounds absolutely amazing on a headline chart, but you need to realize that this is not real, tangible wealth. It is completely paper wealth. It only exists as long as the speculative music keeps playing, and the exact second the liquidity cycle reverses, that paper wealth evaporates into thin air. Bank of America explicitly notes that this massive speculative boom loop will eventually be terminated by 2 specific macroeconomic forces: politics and bonds. Right now, both of those structural forces are flashing bright red warning signals, especially inside the massive semiconductor and artificial intelligence sectors.